All right, welcome back to the channel. Today we're going to be checking out British American Tobacco, ticker symbol BTI. And I've gotten a couple of requests, one request from the Discord and a couple comments on this. And I don't know, people are just interested in this one. I don't know how I feel about it. So I'm gonna check it out. We're gonna look at it, and I really do not have any expertise in this industry, so it might be a little subpar, but we're gonna take a look at it. I have a feeling that people are interested in it just because it's it's down quite a bit, and it looks on the surface. I mean, it looks pretty cheap, right? I think their PE was around like 8 or 9. The dividend yield is 9.1. But what I've noticed is that I don't think they report on a quarterly basis. It looks like they report maybe bi-yearly. It's kind of strange. So we don't have a ton of data to go off of, at least historical data that's going to be really, I don't know, how I would say like normal compared to what we look at usually, where we have quarterly updates. It seems like we mostly just have yearly updates for this one. But with that being said, let's go ahead and dive into their investor presentation. And so, oh man, I don't know about this category in general, just tobacco. And I mean, this is a sell, a purposeful and profitable pathway to a better tomorrow. Wow. You better back that up. Wow. All right. So I've gone through this investor presentation before, and they're kind of pitching the theme of like, oh, like smoking is bad for you because of the combustion, the smoke. Nicotine actually isn't that bad. Like, oh yeah, it's addictive, but you know what? It's not actually the cause of, lung cancer and stuff like that. That's more with the combustion and the smoke that you're actually inhaling. And they kind of pitch these new product lines that they're starting to roll out. And mostly that's like, I think, absorbing or taking nicotine via oral, I don't know, it was like oral patches, and then potentially I'm guessing vaping, right? So they're kind of pitching this multi-category future growth growth in products that they're offering to really consume nicotine, and they're trying to pitch it as a safer, better way, I don't know, more responsible way to consume the products. So yeah, I mean, I do not smoke, so I really, I don't know. I don't have a lot of experience or expertise in this area at all, or in the industry. And then with how split up their financials are, it's kind of a pain in the butt to look at the quantitative aspects of this company, because it looks like they're reporting every 6 months, so bi-yearly is kind of what it looks like. So if we go to their last press release / report, we can see the last one was on the 26th of July 2023, and it's titled Half-Year Report for the 6 months to 30th of June 2023. So the reporting is kind of pain in the butt. And then you look at all like their 10Ks or 10Qs, whatever they have on SEC Edgar. It's all, I believe, in pounds. So then I can't really run a valuation on it, because then I have to convert pounds to US. My valuation model does not do that. So I don't know. It's just kind of been a pain. And I don't know, maybe I'm not finding the right exchange to look at all this data at. So if you guys know of an exchange that has all of the quarterly data, let me know in the comments, and maybe I'll do a follow-up video. But so we can see that they kind of tout revenue up 4.4%. New categories revenue up 26.6%, and that's really what they're pushing right now, is those, I would say vaping and taking nicotine orally. In a non-combustible form. Revenue from non-combustibles now 16.6% of group revenue. So that's really like, when you look at the future trajectory or the future product line, that's really what they're pushing. And yeah, I mean, I see it. I just don't know if it's gonna, I don't know if it's gonna last. I really don't. I feel like you have so many potential issues from, like, I don't know, just society / political health. It's just, it's not like they're selling Coca-Cola here, right? Like, it's not really, in some places, it's not really socially or as socially accepted as other places. They're going to probably run in with like FDA, federal regulatory issues, product issues, advertising issues. Yeah, but anyway, adjustable profit up 3.6% on a constant FX basis. Profit from operations up to 61.4%. It's pretty dang. So is that their 61.4% operating profit margins? That's insane. Or wait, oh no, it's up 61.4%. Okay, meaning they just improved by 61.4%. Okay, so then we kind of get a category breakdown. It looks like flat, THP, cigarette, negative, revenue 4.4. New categories, yeah, so total revenue looks like it's 13.4 billion, I'm guessing. Yeah, it looks like 13.4 billion pounds. And then new categories, 1.6. So that is an increase of 29%. So that is growing quicker. Profit from operations. Okay, so what's that? What's their profit margin? Is that like a 40% then? Right there, operating profit margin, 44.2%. So they've seen an increase of 1,560 basis points on their operating profit margin over the last, I'm guessing, is this the 6-month period compared to 2022? Man, this is just such a pain in the butt. Such a pain in the butt to look through this. But you know what? It's okay. I'm gonna have a good attitude. I'm gonna go through it. It's okay, Jesse. It's okay. So, and then what I thought was funny was I went back to their press releases, and the first thing I start seeing is like, I don't know, like disappointment at FDA marketing denial order for Voos Alto Menthol and Mixed Berry. So I don't know. I mean, it's trading cheap, but I see why, right? So yeah, I don't know. I don't know, guys. It's trading right now. Let's see what it is. BTI stock. Google has it at a PE of 6.45. That's just insane. So let's jump over to the valuation sheet. Let's look at the overview. We can see that its high was probably around $73, $72 over the last 5 years, currently trading at around $31.19. So we're discounted pretty heavily compared to previous highs. The 5-year average multiples, which a lot of these are probably going to be wrong, like I said, because I have mixed data. Like, I'll show you for a second. So look at how, like, I pretty much only get a report every 6 months, and then it goes to quarterly, and then it just drops off. So like I've got something in 2022, and then I just have nothing in 2023 for it. So it's so annoying. Anyway. So we got 5-year average net income yield 9.63%, EBIT yield 13.22%, free cash flow yield of 9.63%, operating cash flow yield of 15.01%. Last 12 months on an LTM basis from the data that I have, it's looking like it's 11.57 on a net income yield multiple. EBIT yield multiple is 15.82. Free cash flow yield multiple is 16.73. Operating cash flow yield multiple of 17.61. So it does look like if my numbers are correct, which they're not. I mean, we already know that there's the currency difference between the pound and the US dollar, and I'm doing a lot of my valuations in USD. So any type of forex change that we're going to have between the two over the various periods is going to skew the results, right? So all this has to be really taken with a grain of salt. But from this, I mean, they look like there might be a little bit discounted to historical averages. If we look at the market cap template and we go to the yields over time, we can see like they've never traded super expensive. They've always kind of traded pretty dang cheap. And you know what? That's probably deserved. I mean, it's not like, I don't know. They're an industry that could have major headwinds from multiple different areas, whether it's just society trends changing, governments pushing for, I don't know, like healthier options, or like increasing taxes, whatever, discouraging the use of tobacco and the consumption of nicotine. Margins have been fairly stable, which is pretty interesting. We've got, gross margins have been right around 80% typically. If these numbers are correct, operating margins were right around 40% typically. Free cash flow margins a little bit lower, around 35% typically. And net margin around 24%. So they've been obviously very profitable. It's one that's going to be kind of hard to value because you really don't know, is the market going to continue to discount it? Is it going to discount it more? Are these headwinds potentially going to turn into lower revenue? Are they not going to be able to keep up with just like their typical growth that they've had over the last 10 years, which you throw in the acquisition in there, and that's where a lot of that growth came from. So on let's look at growth numbers actually. Growth numbers, revenue growth over the last 5 years comes out to about an average of 6.39% per year. So pretty stable. We saw a big uptick in 2018. What was it? 2017, 2018, 16, 17, 18. I think around here is when that acquisition happened, because we probably have, we've got a 10% increase in shares and then 11% increase in shares. So I'm guessing they were doing most of this growth through this area was acquisitive. And then after the acquisitions, 2019, we had about 5.6% growth. We had a little bit of a decline in 2020 and 2021, and then an increase in 2022, and we're going on another increase in 2023. Operating income has increased about 10.2% over the last 5 years on average. And let's see, EBIT growth. Well, we're going off of a bad metric there. So operating income is probably going to be the best to go off of, because we're going off of an EBIT of 30 billion for that 1 year, which was an anomaly, which should be ignored. So EBIT, free cash flow, and net income, EBIT and net income are going to be incorrect in these calculations. Free cash flow, looks like we've got about 17.39% average growth in free cash flow over the last 5 years. But again, a good chunk of that is from the acquisitions they did. So, and along with those acquisitions, they did, I believe, take on a bit of debt. And yeah, you can see that right here. 2017 saw their debt increase from 15 billion to 58 billion, right? So we have an increase in shares, and then we also have a massive amount of debt increase as well. So, so just from those things, even if their multiple gets cheaper, it's probably deceptively cheaper, right? Because you're now taking on more risk with a higher debt load across the company. And they have been paying that off pretty steadily, though. It's getting better and better and better. Looks like the last data point that I have is 37 billion, down from about 58 billion. So they've paid off about 21 billion over the last 5 years, which is a good amount. So let's go over back to the template and I don't know. Let's see what we can come up with. So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. And for the growth, you know what, I'm going to kind of normalize this. I really want to look at operating income, because EBIT and the net income and free cash flow is kind of going to be, looks like it's those one-time anomalies are really throwing us off. So if we get 10% operating income growth, which would pretty much assume the same probably 6-7% growth going forward, along with maybe a little bit of increase in efficiencies and operating margin expansion. So let's go ahead and plop that in here. We're going to do 20. And we look at the yield multiple, and geez, it's just so, I don't know. Sorry, that's historical growth rates. The yield multiple is like, you just don't know where the market's going to value this. Like maybe best case scenario, it gives it a yield of like 7.5. I don't know. Worst case scenario, like 18. I don't know. Yeah, it's really hard to pin this one down. So let's go negative 2.5. Do that across all of these just to get that adjustment. Actually, negative 3. Let's see here, negative 3, 7.2. Okay, cool. Probably best case scenario right there. And most of your return right now is going to be coming from the form of that dividend, which really should give us a hint to go in and investigate how safe that dividend would actually be. It looks like it has been pretty stable. They may have cut it recently about 4 cents from 74 to 70. Dividend payout ratio, let's see. Payout ratio seems to be like around 50%. Let's see, free cash flow statement. Where are we going here? Okay, so we've got free cash flow. It's pretty good. Stock-based compensation is pretty minimal. Dividends paid, 1,474 versus, yeah, so payout ratio seems to be around maybe 40-50%. Just looking at these numbers here. And then they did start to, well, this is also 21, 22, so maybe we just need more insights into the quarterly data. They did start to repurchase common stock in 2022, it looks like. So, and I don't necessarily disagree with that. Like if you believe that your cash flows are going to be super stable, the market's trading you at a discount, and is going to trade you at a discount for the foreseeable future, you basically have 2 options as a company to return capital to shareholders. And that's through the form of dividends and buybacks. And a balanced approach can go a long way, as long as you're keeping your debt levels in check. You know, they could also potentially pay off debt a little bit quicker, but their leverage ratios don't look, I don't think, that bad. If we go to REIT metrics, which this will just show us some of those leverage ratios. So interest expenses to operating cash flow is pretty tame. It doesn't look that bad. So we have a cash flow coverage ratio of around 24% and a interest expense to operating cash flow of about 16%. So cash flow, let's see, compared to their total debt, their cash flow covers probably about 25% of their total debt on a yearly basis. and their interest expenses are only taking about 16% from their operating cash flow on a yearly basis, which isn't that bad. So, and this kind of gets back to what somebody in the Discord was asking me was, hey, if you know a company, like theoretically, we never know what is going to happen in the future, but if you knew that a company was going to have like, really, really steady cash flow, muted growth, but the revenue streams were going to be solid, their margins were going to be solid, they got like a 50% payout ratio for their dividend, but they're not going to grow, or they're going to grow like at the rate of inflation, would you be interested in them? And this was before I knew it was BTI, but I was like, yeah, of course, because like there's a lot of financial engineering that can be done from the company on a quantitative side, right? Like buying back shares. Like if a company is going to forever trade at a 10 PE, right? Well, then they can still return that capital to you in the form of dividends and buybacks, and strategic smart buybacks, right? And then as they kind of just cannibalize their shares, their earnings per share is going to go up, right? And if the market keeps trading them at the same multiple, well, that's going to increase the stock price because you're lowering the share count, your net income staying the same, right? Earning per share goes up. Market gives it the same exact valuation, theoretical example, but you would get price appreciation just from that. So at a minimum, I would want a company growing at the rate of inflation, like at a minimum, right? But so for this one, I don't know, I'm personally, I'm not interested in this at all. Okay. That's just me. You might think differently. I will try to value it. I'm going to assume actually a little bit of buybacks because it looks like they are doing a little bit of buybacks. So maybe we throw a little bit of buybacks in there. We're going to do a yield spread of 7.82% in the best case scenario. I think that's like a good case scenario. And then we're going to up this a bit. We're probably going to do like, yeah, that's probably good. Yeah. So 7.82 in the best case scenario, 17.58 for the yield metric, or yield multiple in the worst case scenario. Now, do I want to use EBIT? Yeah, we'll do a normal valuation. We're not going to pick any single one of these. We'll do a normal valuation. Go off of the average of EBIT, net income, and free cash flow. And then we get, let's see, target rate. We'll do 10. We're already applying the discount there, so 11. No, shoot, sorry. 8. 8.5. So we're targeting a total return of about 20%. In this scenario, it assumes that they're going to keep their dividend at 9.1%. So 9.1% of that return is coming from the dividend, and then 11% is coming from price appreciation. So, yeah, under all of these assumptions, BTI could be interesting, quantitatively, under these assumptions, if they happen to play out, which I have very little confidence that they will. So, oh man. So with these assumptions, we get a current fair value of anywhere from $27 to maybe like $40, $50. That's really low case to best case. The buy scenarios, or the buy ranges, scenario 1 buy range or buy price would be $20.89. Scenario 2 buy price would be $26.99. Scenario 3 would be $35.25. Scenario 4 would be $46.67. Scenario 5 would be $62.84. But remember, all of these numbers are probably incorrect. They are incorrect because I'm not doing Forex adjustments. Oh man, I shouldn't have done this video. I shouldn't have done it. But yeah, so I don't know. That's what I got. I'm not interested in this company or this industry at all. There's just too many like things that I'm just like not a fan of. Like, well, first off, just not being a fan of the industry in general. Not a fan that they don't have quarterly reporting. Not a fan that they have like bi-yearly reporting or twice a year reporting. I don't know. I just nah. Anyways, this is it. This is the BTI video that people have asked for, and you probably didn't help you at all. So I hope you guys have a good week, good day, and we'll see you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.